All right, let's talk about one of the most fundamental problems in all of trading. What do you actually do when the price comes up to a huge level on your chart? Well, our source material from babypips.com breaks this whole thing down into just two simple, really powerful ideas. Let's get right into it.
And this is it. This is the big question, right? It's what every single trader has to figure out, often in a split second. You see the price getting closer and closer to that line you drew, and your heart starts to pound a little. Is this thing going to hold and reverse, or is it going to smash right through like it's not even there? Pretty much everything we do next boils down to how we prepare for those two outcomes.
So here's the good news. You don't need a crystal ball to figure this out. The source material makes this so much easier by giving us two distinct playbooks to follow. One for when the level holds, they call that the bounce, and another one for when it fails, you guessed it, the break. Okay, let's start with path number one. This is probably what most people think of when they hear support and resistance. And this strategy is all about one thing, patience. It's about letting the market prove you right before you jump in.
So, what exactly is the bounce? Well, think of it as a strategy of confirmation. Instead of just blindly betting that a level is going to hold, you wait. You wait for the price to actually hit that level, turn around, and start moving away from it. And only then do you even think about putting on a trade. You're reacting, not predicting.
And here it is. This is the question that gets so many traders into trouble. I mean, it's so tempting, isn't it? You think, man, if I can just put my buy order right on that support line, I'll get the absolute perfect entry. But as our source material makes very clear, that's a really dangerous game to play.
And this image right here shows you why. Just look where that entry is. It's not on the line. It's after the price has already bounced and moved away from the line. See, this is how you avoid what traders call catching a falling knife. You're waiting for proof, for confirmation that other buyers are actually stepping in and defending that level before you risk your own money.
So, let's just break down why this is so important. Why wait? Well, first, it confirms that the level is actually valid, that the market cares about it. Second, it really does tilt the odds in your favor because you now have evidence that your analysis is correct. And third, and maybe most importantly, you avoid getting run over. If the momentum is strong enough to break that level, you're not standing in front of the train.
Okay, so let's flip to our second strategy. What happens when that level doesn't hold? What's the game plan when the price just slices right through it?
And let's be real about this for a second, because the source points it out perfectly. These levels are not some kind of magic force field. They're just areas of interest where a battle happens. And you know what? Sometimes one side just wins and the level breaks. It happens a lot. So only playing for bounces isn't going to cut it.
And that brings us to the break strategy. Now, just like with the bounce, the key here is not to panic and act impulsively. When a level breaks, you absolutely do not chase the price. Instead, you wait. You wait for it to come back or pull back to that very same level it just broke through.
This illustrates it perfectly. Look at that. The price crashes through support. Your first instinct, your emotional response, is probably to hit the sell button right away, right? To chase that move. But the patient, professional strategy is to wait. Because very often, the market will come back up to retest that broken support, which has now become resistance, and that is your much higher probability entry.
Okay, so we've got our two strategies, the bounce and the break. Sounds pretty straightforward, doesn't it? But now we have to talk about the real work, because trading is never as clean as it looks in the textbook diagrams, and this is where risk management becomes absolutely everything.
The source material puts it so well, you know? In a perfect world, these patterns would just work every single time. We'd see a bounce, we'd buy. We'd see a break and a pullback, we'd sell. It'd be like our own personal money printing machine.
But you and I both know that's not how it works. That is the hard truth. The market is messy, it's unpredictable, and it definitely doesn't owe us a perfect setup. These patterns can and absolutely will fail.
I really want to pause on this for a second because the source puts this in all caps for a very, very good reason. This is a critical warning. Sometimes the price is going to break a level and just keep going and never look back. If you're sitting there waiting for a pullback that never comes, you just miss the whole move. But more importantly, if you're on the wrong side of that, you better have a plan.
So these are the rules you just can't break. These are your non-negotiables straight from the source. First, you have to accept that sometimes the price is just going to run away without you. Second, you always, always, always use a stop loss. You have to know exactly how much you're willing to lose before you even get in. And third, you never, ever hold on to a losing trade just because of hope. Hope is not a trading strategy.
So after all of this, after looking at bounces and breaks and all these warnings, what's our actual edge as a trader? What's the one thing that really connects both of these strategies and makes them work over the long run?
Take a look at these two diagrams right next to each other. On the left, we're waiting for a bounce before we buy. On the right, we're waiting for a pullback before we sell. I mean, they're for completely opposite scenarios, but they are built on the exact same powerful principle.
And that's it. That's the secret ingredient. It's patience. But we're not just talking about sitting on your hands and being calm. In trading, in a game of pure probabilities, patience is your statistical edge. Your advantage doesn't come from being some genius who can predict the future. It comes from having the discipline to wait for the market to give you a signal, to give you confirmation.
So let's just put it all together in a simple 4-step process. Step 1, you find your key level. Step 2, you do absolutely nothing. You just wait for the market to show you how it's going to react to that level. Step 3, you wait for your specific confirmation signal. That could be the rebound from the bounce or the retest from the break. And finally, step 4, if and only if you get that signal, you enter your trade with your protective stop loss already in place.
You know, at the end of the day, understanding the bounce and the break, that's the easy part. The hard part is all internal. The real question isn't about how well you can read a chart, it's about self-control. Do you have the discipline to actually sit there and wait for your perfect setup when every impulse inside you is screaming to just jump in? That is what makes all the difference.